Okay, so this week we're diving deep into the Colombo Stock Exchange, looking at October 13th to the 17th, 2025.
hmm
And analysts are buzzing about this thing called the domestic momentum rally.
Yeah, it's quite something. The big headline, both main indices, the ASPI and the S&P SL20, they actually hit new calendar year closing highs.
New highs, the all-share price index, the ASPI, closed the week strong, really strong, 22,633.80.
An incredible number. But the really fascinating part, the paradox here, is how it got there. The market basically just ignored foreign institutional investors,
Right.
completely decoupled.
Right, that decoupling is the core of the story, isn't it?
Yeah.
We actually have the numbers on the foreign capital flight. It was significant.
hmm
A net foreign outflow for the week of about Rs 3.38 billion.
Mm.
Foreign institutions were systematically selling.
Yeah, heading for the exits. But, and this is the kicker, domestic investors showed up. Big time.
They absorbed it all.
Every bit. They were the only reason prices went up. Match that outflow exactly.
Mm.
A net domestic inflow of Rs 3.38 billion. Local money just, well, vacuumed up everything the foreigners were dumping.
Wow. 3.38 billion absorbed locally. That's a huge amount of local conviction. Is that incredibly risky, or does it genuinely signal something fundamentally strong that the foreign players missed?
Well, it tells us a couple really interesting things about the current market dynamics.
Yeah.
First, clearly there's a lot of domestic liquidity and a very aggressive local risk appetite right now.
Okay.
And second, that traditional gauge, the foreign flow indicator, it seems almost useless right now as a predictor. Local confidence is firmly in the driver's seat, regardless of maybe some global warning signs.
So if locals are driving, where's that 3.38 billion actually going? Is it the safe blue chip stocks?
Actually, no. Quite the opposite, interestingly. The ASPI, the broader market index, yeah, it gained a solid 1.41% for the week.
Right.
But the S&P SL20, which is just those top 20 blue chip stocks, it only grew 0.59%, much slower.
Ah, okay. So that confirms it. The rally's real power wasn't in the big names. It was concentrated elsewhere.
Exactly. Outside those safer bets. Smaller stocks, higher beta ones that tend to swing more wildly.
And you can see that reflected in the valuations too, right?
Yeah.
That aggressive expectation.
Absolutely. Look at the price-to-earnings ratio, the PER. It moved up from 9.87 to 10.03 just in that week.
So people are paying more relative to current earnings.
Precisely. Investors are betting more now on future earnings recovery than they were just the week before. Those higher expectations are getting baked into prices.
And this brings us to the risk element. There's a stark example, Mercantile INV, top weekly gainer, up an absolutely staggering 125%.
125%.
Yeah. But, and this is crucial, that massive gain happened on almost no trading volume, just 180 shares traded all week.
Wait, just 180? Wow, so that 125% wasn't really widespread demand. It's more like a warning flare, maybe? Yeah, it screams illiquidity risk. It shows how a tiny bit of buying in certain pockets can move prices dramatically because there just aren't many shares changing hands. For anyone holding those kinds of stocks, it highlights, just how fragile things might be. Potential for sharp reversals.
So looking at the bigger picture, the sectors, where did most of that domestic money flow thematically?
Utilities seem to attract a lot of confidence. That sector showed the strongest growth, around 1.93% indicative growth. And diversified financials were also strong, up about 1.41%. Those were the clear winners.
Okay, so let's synthesize this. We've got new market highs, which sounds great, but it's built entirely on domestic buying that's soaking up a consistent foreign sell-off.
That's the picture. And it means the margin of safety, it's definitely getting thinner. The market strength is completely dependent on that domestic confidence holding up. Makes it very vulnerable to sudden sentiment shifts, doesn't it? Or, any unexpected policy news.
Right, so tighter stop losses might be wise for those in these domestically driven stocks.
Definitely prudent right now, yes.
Which leaves us, and you listening, with a really provocative thought. If local investors felt confident enough to pour in Rs 3.38 billion while sophisticated foreign institutions were systematically pulling out that exact same amount, what underlying structural risk might those foreign sellers see that the local market is perhaps overlooking, something to really mull over? When most people glance at financial market reports, they probably just see, well, a load of dry numbers.
Yeah, just data streams.
Exactly. But we know there's more to it. If you really look closely at that raw data, the daily trades, the volume, the index movements, you're actually seeing the whole corporate story play out, almost in real time.
That's absolutely right. And today, we're really digging into a specific set of data. We've got a stack of raw market reports from the Colombo Stock Exchange,
Okay.
focusing on mid-October 2025.
Hmm.
Specifically, that's the 13th through the 17th. And the sources, well, we've got the daily movement reports, index stuff, bond sheets too.
Ah, the multilingual ones.
Yeah, exactly. The ones with the Sinhala, Tamil, and English headers. Always fascinating to see.
Right. So our mission really is to get past just the headline index figures. We want to feel the real pulse of the market during that specific week. Who was buying? Who was selling? What were the hidden corporate moves? The nuts and bolts of what was actually going on underneath.
Finding that story within the high-frequency noise, so to speak.
Precisely.
Mm.
Okay, so let's kick off with the big picture, the market pulse via the main index. Looking at the S&P Sri Lanka 20, say, between October 13th and 14th, it went from about 6,207 to 6,225.
Right. So 6,200.37 up to 6,225.52. It's a gain, yeah, but like you said, fairly small on the surface.
Less than, what, 0.3%?
Yeah, something like that for the price index.
Mm-hmm.
But that small rise, it kind of hides what's happening underneath, doesn't it?
It really does.
Because the total return index, the TRI, which includes dividends and things, it moved pretty similarly.
Yeah.
12,644.29 to 12,681.26. So the overall trend, yeah, slightly positive, mildly positive.
Finally, until you look at the turnover, the daily trading volume was, well, all over the place this week.
Volatile is the word.
Yeah, like Tuesday the 14th, turnover was around 5.7 billion rupees, give or take.
Okay, 5.74 billion. Got it.
But then fast forward just 2 days, around the 16th, that number just exploded, over 8.87 billion rupees.
That's a huge jump. What's that, over 50%?
Easily. A 54% surge in capital moving in just 48 hours. It makes you wonder, right?
Absolutely. Was it some big news on the 16th? Like an economic announcement we missed? Or was it just big institutions piling in, maybe chasing some of those earlier gains?
Well, I think to answer that, you have to look at the daily gainers. The index might have been sort of drifting, but man, some individual stocks were just flying.
Yeah, the momentum was crazy in pockets.
Looking at the top 10 gainers list for that Tuesday, October 14th, I mean, we're talking double-digit percentage gains in one day.
And this is where it gets really interesting, because it wasn't just one type of company. Up top, Windforce, renewable energy. It jumped a massive 26.88%.
26%, okay. And right behind it, Tess Agro up 18.75%. So you've got green energy and agriculture.
Two really distinct, but yeah, crucial sectors, both seeing just, like you said, insane short-term interest.
There wasn't a rising tide lifting all boats then.
Not at all. It felt very targeted. AMFCO Ltd also popped 18.02%. And even lower down, you had Raygam Salterns up 11.49%, Lanka climbing 10.73%.
And we saw others too, right? Pan Asian Power, Dilma Ceylon, and SMB Leasing's non-voting shares X. So what this screams to me is that a big chunk of that record turnover we saw, it was investors chasing these really high-risk, potentially high-reward stocks, willing to ride some serious waves for those kinds of explosive returns.
Yeah, definitely a risk-on sentiment in specific names. Yeah. And that volatility naturally leads us to think about the corporate landscape itself, which thankfully the reports break down quite nicely. It's not just one big market, right? You've got the main board, the second board, the Dairy Savvy board, and that watch list section too.
Okay, let's pause there. For someone looking at this data, why do those different boards matter? What's the real difference between, say, the main board and Dairy Savvy?
Good question. It's basically about risk and scale. Yeah. The main board. That's usually your big established companies, strictest rules for reporting, financials, all that.
The blue chips, sort of.
Kind of, yeah. Whereas the DRI Savvy board, that often has smaller companies, maybe higher growth potential, but also, different listing criteria, maybe less stringent reporting.
So potentially more risk, but maybe more upside, like those momentum stocks we just talked about.
Exactly. It could attract those kinds of traders. And the reporting itself, that's crucial. These daily reports track all sorts of required corporate actions. They're not just filings, they're signals, right? About company health, strategy, stuff investors need to know.
Definitely. You see categories for things like director changes, resignations, appointments.
Yep. And financial reports coming out, notices for AGMs or EGMs.
Yeah.
That's the basic transparency layer.
And the really critical ones, capital changes. We should probably quickly touch on two we see here. Scrip dividends versus rights issues. They sound similar, but they mean very different things, don't they?
Oh, completely different signals about cash. A scrip dividend means the company gives you shares instead of cash. Usually means they want to hang on to their cash, but still reward shareholders, sometimes tax advantages too.
Okay, preserving cash.
Right, but a rights issue. That's the company coming back to existing shareholders and asking for more cash to raise capital.
Which can dilute your existing shares.
Potentially, yes. So investors read those two announcements very, very differently. It really matters.
Puts the focus on the fine print for sure. We also see alerts like trading halted or dealing suspended. Those are regulatory flags, right? To protect investors when things get too wild or there's big news pending.
Precisely, market controls. And looking at where the actual trading volume was concentrated, it's revealing. You can sort of tell which stocks are the liquid, trusted ones just by seeing how often they pop up.
Yeah, I noticed that. Companies like Ceylon Land, Access, IngSL, SMB Leasing again, Royal Ceramic, Dipped Products. They seem to be trading heavily pretty much every day.
Those are like the market workhorses. Stable counters where money flows in and out reliably, liquidity hubs.
Okay, so we've got this picture. High volatility in some specific stocks, but also consistent volume in these core names. Let's zoom out a bit and see which sectors were driving things overall during the week. Right? Which brings us neatly to Section 3. Sector health. If we compare how the price index for different industry groups moved over that whole week, maybe we can spot the real momentum.
Yeah, that's a good approach. And if you look at diversified financials, for instance, its price index moved quite a bit between the 13th and the 17th. Went from 3,251.16 up to 3,488.17.
Wow, that's a solid
It
climb.
really is. Suggests pretty broad confidence in the financial sector that week. Maybe expecting good results or feeling better about the economy overall. Hard to say for sure, but the trend is clear.
Okay, but contrast that with, say, telecommunication services. On the 13th and 14th, its index was just flat, 1,470.20 both days.
Yeah, stuck in neutral.
It did pick up later in the week, hitting 1,557.36 eventually. But it shows a definite lag, right? Financials were already running while telecoms were sort of playing catch-up.
Exactly. Maybe waiting on specific news or policy changes, who knows? But that hot-cold difference really comes alive when you look at the valuation metrics.
Ah, yes, the ratios. PER, PBV, DY.
Price to earnings, price to book, dividend yield. These really help define the risk and potential return at a sector level.
Okay, I have to ask about the price to earnings, the PER, because retailing stood out. It had a negative PR, minus 13.1 on the 13th, minus 12.41 on the 14th. Why are people buying into a sector that's clearly losing money overall? What does that even mean?
Well, it's fascinating, isn't it? A negative PR means, yes, the sector as a whole lost money recently, systemic losses perhaps.
Right.
But the fact that prices are holding up or even rising slightly suggests investors aren't focused on current earnings. They're buying based on the hope, maybe strong hope, of a big turnaround later.
So pure speculation on recovery.
Pretty much. Or maybe confidence that future earnings will massively outweigh these recent losses. It's a very aggressive, forward-looking bet, not about today's profits at all.
Okay, that makes sense. And then you have the total opposite strategy showing up too, people looking for steady income. Utilities had a decent dividend yield, right? Around 3.98.
Yeah, 3.98. And diversified financials were also pretty good, fluctuating between 3.71 and 3.01. Those are solid numbers if you're focused on getting regular cash flow. Predictable.
Very different from betting on a retail turnaround.
Completely different mindset. And one more ratio we should mention. The high price to book value, PBV, in food, beverage, and tobacco, it was up around 6.35, 6.39.
Okay, PBV, price to book. So the market value is over 6 times the accounting value of their assets.
It's essentially, yes. It means the market is valuing these companies way above their tangible assets, their book value.
So it's about the intangibles, brand names, consumer loyalty, that sort of thing, especially for food and drinks.
Exactly. Think about trusted tea brands or consumer goods. That trust, that brand recognition, it's not on the balance sheet in the same way a factory is, but the market clearly values it very highly.
Paying a premium for consumer trust. That's a really interesting signal for this period. It's easy to get caught up in those flashy equity gains like Windforce jumping 26%. But the bond market data tells a whole different story, doesn't it? More about caution, long-term planning.
It really does. It's a crucial pivot. We go from, high-risk capital chasing quick gains in stocks to large companies needing stable long-term funding. These bond listings, they show you the corporate borrowing strategy, plain and simple.
You can almost see the CFOs thinking, right? The bond codes themselves lay out the coupon rates, the maturity dates.
And look at the cost of borrowing for some of the big banks. H&B, for example, had bonds out there with coupon rates from 12.6% all the way up to 13.5%.
Whoa. 13.5%. That's not cheap money.
Not at all. That's significant high-yield debt they're taking on. Tells you something about the perceived risk or the need for capital at that time.
And the amounts being raised are huge, too. I saw NDB bonds listed with issued quantities between like 16 million and 78 million units.
Yeah, that they're raising serious institutional money through these issues.
And it's long-term money, too.
That's the other fascinating part. You see bonds like that H&B one maturing way out in August 2034, nearly a decade away, or a BOC issue maturing in May 2030.
Locking in funding for years.
Exactly. It gives you this visibility into the long-term financial planning underpinning these major institutions. Stability.
And it wasn't just banks doing this, was it? The issuer list seemed pretty broad.
Oh, yeah. Banks, sure. DFCC, HNB, Sampath, Ceylon.
Yeah.
But also diversified financials like MBSL, First Capital, LOLC. Then you have big industrial names, Ailey's, Browns, and even utilities like HPWR.
So across the board, major players were tapping the debt market around mid-October. Suggests a pretty widespread reliance on bond financing then.
Okay, so let's try and tie all this together. Looking back at that mid-October 2025 week on the Colombo Stock Exchange, what's the big picture that emerges?
Well, definitely high investor activity, right?
Okay.
Those turnover spikes tell a clear story.
Huge activity, especially midweek, and really sharp, sometimes dramatic volatility in specific stocks. The excitement seemed anchored in those high-risk areas like renewables.
Yeah, Windforce being the prime example. But underneath that, the sectors showed these interesting valuation differences, like that sort of aggressive hope baked into the negative PRR for retail.
Right. Rational, but sometimes speculative valuations were definitely present. But maybe the most compelling thing is the duality we saw.
How so?
Well, on one hand, you've got this clear appetite for high-risk stocks, chasing those massive Windforce-type gains, big potential reward, big potential risk. But at the same time, you have these corporate giants locking in huge amounts of capital through the bond market, issuing long-term debt, often with really high, clearly defined coupon rates over 13% in some cases.
So extreme risk-taking in equities alongside a big demand for relatively safe, high-yield corporate debt.
Exactly. Which creates this fascinating puzzle for